Greetings, everyone. I'm excited to welcome Paul Singh, CEO at Strata. Paul, welcome to the show.
Ben, thanks for having me here. Rule number one of whenever I get on somebody's show is to try to tread carefully between that line of never getting invited back, but giving your audience actionable info. So let's see how this goes.
Let's see how it goes. I've had a couple repeats on the show, so we'll see if you make it to the repeat, group.
fingers,
Uh,
fing-
but
fingers
let's, yeah,
crossed.
yeah, let's dive right in. Tell us a little bit about your background.
Okay, so I'll try to do the 60-second version.
Mhm.
Home for me, I tell people I do my taxes and my laundry and I take care of my kids in Virginia, but often I'm on the road. Our company is almost fully remote. Our customers are spread out through the country, so I'm always on the road. Quick background, grew up here, went to high school and college here at George Mason University. Never thought I was an entrepreneur. I'll tell you that story if you want, but I stumbled into starting a web hosting business in the late 90s, right time, right place, a lot of execution, and I was too dumb to know what I couldn't do. It sort of evolved into 6 large data centers that I still operate here in Virginia. Then about that was by 2004, and then a couple years later, I started angel investing. I didn't know what that was because there's not venture capital in Ashburn, Virginia, where I live. I mean, it wasn't then, probably isn't really now either. Started angel investing. My super secret strategy was just get on a cheap airplane ride every Tuesday, see where you end up. I didn't have kids, I wasn't married. Started angel investing, did a couple hundred deals that way, then kind of institutionalized it, co-founded a venture firm called 500 that's still around today. I think there's about 5 billion in assets under management under there. Very early stage capital. We're usually the first money in to companies like Mint and Credit Karma, Twilio. Uh, I could kind of name off a bunch there. Spent the next couple of years after we got that up and running to like I had my first kid, started like kind of thinking more about being a dad, led me to co-found my third business called Bump. And we started out as a subscription box company for expecting moms. But over the years, found myself falling into this world of jargon, RCM, DME, and everything else in there. And I was like, what is this? And it tripled our revenue within a year or so. And we started to really understand what it was. And that led me here to Strata, which was actually founded by somebody I went to high school with, as my daughter says, in the 1900s. I came in about 3 years ago, I guess now, took over as CEO 2 years ago, something like that. And we've just been heads down focused on growing and that's where we're at today. So that's the history. And before anybody says anything complimentary, I'll just say I all I know is I just tripped and stumbled my way forward. And I think success is really a function of the number of things you try. So
Appreciate that background. Love that. And before we talk about Strata, tell me a little bit. It seems like a lot going on. Where are you spending your time? Is it 80% on Strata, 100% on Strata? Like how are you dividing your time with everything that's going on right now, roughly?
Oh, I would say it's 99.999% strata. I
Okay.
mean, we've got great teams. So my I don't have an MBA. I don't have any of those like fancy degrees or anything like that. If you look at sort of my history, I've just always been interested in this idea of like let's try a lot of business ideas, and when one sticks, let's go heavy into it until we actually build it, get it sustainable, get a great team in place. Because there's things I'm good at, there's things I'm not. So I think I'm relatively good at building and growing things. I am not good at running them. There's other people that wake up excited to do performance reviews and things like that. So yeah, but full disclosure again, almost 100% on Strata. And when I say almost, it's like I don't know, once a quarter, I probably need to do like a quick oversight meeting with my other companies to make sure everything's
Yeah.
good, governance, that sort of thing. But that's my and even now, when you look, if you were to talk to my direct reports at Strata, I always tell them like, look, how I know you'll be successful in the short term is that things get better in your area of ownership. And in the long term, I know you'll have been successful if half your calendar is empty, and so we can
Mhm.
unpack that if you want, but that's kind of how I think about it.
Well, no, appreciate that insight because, right, it can be hard to focus on one thing with a lot of things going on, founder dilemma. But yeah, let's talk about Strata. Tell us what products and or services Strata offers.
Yeah. So today we are what we call a billing aware practice management platform. So the way we think about it is that, every practice, PTOT speech is what we serve, but for every outpatient practice out there, you've got the need for an EMR, you need scheduling tools, you need marketing tools, you need all these things. And, our thesis is like why shouldn't that all be baked into one platform? And more importantly, the subtle but very important piece is everything we build is supposed to be billing aware. So when we think about even simple things like patient reminders, obviously we don't want to annoy a patient, right? But at the same time, imagine getting a patient reminder from from your doctor that says, "Hey, just confirming tomorrow's visit, press 1 if you need to reschedule." Well, it's a very subtle little feature where most people, like standalone patient scheduling tools, don't think at that level because everything's about MRR and ACV and all the business terms or whatever. In our case, we just give away the software free. It's part of our service. And then, where we make money is that we keep a percentage of everything we collect. And, the average customer that comes to us usually is terminating 3 or 4 other software contracts and just coming into one platform, one price, and all that stuff. So that's kind of a mouthful there, but this is the interesting part to me is how compartmentalized this industry's been taught to believe things are. Like it's like you got to have this, this, and this. It's like no, no, no. I think the payments infrastructure of healthcare in 2024 looks a lot like the payment infrastructure of the broader technology space in 2004. PayPal didn't exist, Stripe didn't exist. I mean, it was crazy. You had to get a black credit card swipey thing, if you remember that thing from way back when. I won't age you, by the way. I'm 43, so I remember that thing. You break your knuckles just scraping your credit card there. Anyway, my point is that like I think anyway, billing aware practice management. I told you my superpowers are ramble, so keep me honest here.
Yeah, and so yeah, interesting because I got my software started mentioned before in healthcare and in EMR and practice management. Those were two separate solutions going into the physician office. Now it sounds like so you're focused on when we talk PTOT, so physical therapy. Now OT, occupational therapy.
Yes, I'm
Yep,
sorry. Yeah,
and
physical
speech.
therapy, occupational therapy, and speech. Yeah.
Okay.
Yes, and and actually and I'm gonna say this, bluntly for the sake of time, and I mean no disrespect to anybody, but I would say we started in PT because our founder, Kim, who's still with the company, by the way, Kim was in, PT, like she was in the PT office world for a long time. So we started there. And then as we grew over the years, OT, it just sort of became a natural fit. A lot of PTs have OTs in the office with them, and then speech became a natural fit. But purely from a technology standpoint, we don't really our software and our systems don't differentiate between, you know, let me not dance around the topic. PT, OT, and speech is sort of the bread and butter now, but
Mhm.
if you sort of connect the dots on where we're headed with our platforms and things like that, there's a lot of other outpatient medical disciplines that are, in many ways, very, very similar, even if the underlying workflows are slightly different. So just imagine what the Stripe for healthcare would look like. That's where I get really excited.
And so I definitely want to talk about your pricing model, but so with your platform, bringing, kind of like a, focusing on this vertical within healthcare, are you going against some of those? Are there big players that you're going against, giant companies, or what's the competition like in this slice of the healthcare market?
Yeah, it okay. So I'm going to just be very blunt. We do have competitors,
Hmm.
and I would say that most of those competitors they could be probably lumped just for simplicity's sake. They could be lumped into two general buckets. One would be sort of the other large EMRs that are out there, EMR, EHR,
Hmm.
whatever you want to call them, the platform for managing medical practices. That would be bucket number one, and then bucket number two would be sort of the rest of the software stack, RCM, practice management, scheduling, all that stuff. And so one of the more difficult parts here of our business is really trying to kind of unwind that mental model that people have, right? Because we as humans, we're trying to bucket you into something we already understand. Are you an EMR? Are you not? And this topic I think is deceptively interesting because nobody really wants to think about this. Well, anyway, we have competitors, and depending on where you're coming from, we will change our language. Like if I can
Hmm.
tell where your mindset is and what you're trying to bucket us into, we'll then speak to that. I'll just kind of maybe throw two little teasers out
Hmm.
there in case it's of interest to the audience. Number one, I think it's interesting to maybe talk about what like this topic we're talking about is really about trying to subtly but firmly create a subcategory and then educate people to it. We could talk about that because there's examples I can point to like Kodak and and others that we can look at. The other topic that could come out of this, if you think it would be interesting to the audience, is this idea of, like, how did we even end up here? What in the world? Like, why is this industry the way it is? Why is like somebody without any PT credentials even qualified in any way to be involved here? We can talk about either of those, but let me turn it back to you. Where
Yeah,
what
yeah,
would
we'll
the
talk
audience?
because it's interesting because what the year that you founded your company, but just real quick, before we move on here, because you said you don't charge for the software, no MRR, but you're keeping a percentage of collections. So I assume, right, you're helping, that billing and the coding and the billing goes out the door and you collect on that. So so you truly have just a purely variable revenue stream here. So tell us a little bit about that thought because it seemed like right usage-based revenue got really popular and then we hit the pandemic and if you didn't have kind of what I call safeguards where it could go to zero, a lot of companies suffered unless they were in like, the restaurant like, hey, take out food. So tell us about your thoughts around that pricing model and do you ever see a point where people are like, hey, I don't want to keep paying you on a I don't know if they get big and like, hey, that's a big chunk of money that's going out the door where I could go somewhere else and just have a fixed ARR contract.
Okay, so yeah. Okay, so these are good questions, and I want to make sure I answer all of them. So keep me honest here, because I think you rolled a couple in there together,
Mhm,
and I don't want to like skirt the questions. So first off, yeah, our entire model is built around this idea of the software's free, everything's free, and we keep 7% of everything we collect. Now, at face value, people are like, whoa, whoa, whoa. I could outsource to India or to that mom and pop in Idaho for 3%,
mhm,
right? And to that, I would say, yeah, do it. Do it. And I know that sounds controversial, but hear me out for a minute. On the flip side, when we think about it, it's like, wait a second, how do you actually collect on every dollar you're owed? Most of our RCM competitors, meaning other competitors purely on the billing side, usually use some form of labor arbitrage to solve this. What they do is they say, we've got an outsourced team of 300 people in India or LATAM or Wyoming. They may not say it that way, right? But they're like, "Our service is aligned with your outcome," or whatever. It's like, well, that's not true, because if that was true, Strata would not exist. Like, we literally would not exist if that worked, because the reality is that, yeah, you can, even if you have the labor arbitrage of outsourcing to a third world or something like that, or a third country, there is gonna come an economic point where it doesn't make sense to put a person after a $4 claim or a $7 claim. So this is a very important point of like, this is where you need technology. Like our entire back end systems for the year over the years has been built around this idea of like how do you fight, how do you fight the big payers? Well, it's got to be through machines. And then secondly, what else has to be true to make this work? Well, you kind of have to make sure that every feature, everything you build has to be tied back to patients, visits, and units. And this leads me to maybe touch on maybe the next question you asked, which is like, well, how do you make sure that I think the way you worded it was, how do you make sure you don't like end up with a zero revenue month or something like that?
mhm,
Okay, well, that first of all, let's admit we can't control that, right? Like if the
mhm,
next COVID hits, obviously, that's difficult, right? But that being said, though, it really this is gonna sound overly simplistic. When our EMR competitors show you a product roadmap, almost everything they build tends to be tied to this idea of like, "Hey, by the way, we're not gonna tell you there's a pricing increase coming, but all this additional value we're adding to the product, don't be surprised if the price goes up." I mean, you don't I'm not gonna, like, call anybody out specifically, but lots of EMRs have raised prices over the last 12, 24 months, and it's not because of inflation or anything like that. It's just that if you look at the world through traditional SaaS lenses, everything is about MRR, ARR, average contract value, all that stuff. In our case, our entire product roadmap is built around this idea of patients, visits, and units. So, if I were to, like, pull up a screen share and show you our roadmap for product, yeah, we think about, should the button be red or blue? What's the conversion rate? Da da da. But the way we think about it is if we roll out this particular feature or upgrade or whatever, how, how does it affect one or all of those metrics for our clients? Because if that happens, then it should drive more units through the bottom of the funnel, more money for the practice, more money for us, that sort of thing. So, again, I know it's kind of like I'm not trying to dance around the topic. It's just such a difficult thing to talk about because it is the key. Like, we're not secretive about it. We think a lot about patients, visits, and units. In fact, it's the top 3 metrics that we look at on a daily basis. So, I think there were a couple other questions buried in there. I just wanna be
Well,
respectful and not
no,
skirt
I know.
them. So
Yeah, I appreciate that because that gets to say because right, and obviously the investor side of like, hey, we want sticky revenue, we want to moving up and to the right, and if it's unpredictable, it's hard to value those revenue streams. But I'm guessing right, you're tied to their operations, their economic viability and where they're going, and also have the product usage side of like patients, visits, units flowing through your system, flowing through their practices. So, do these businesses or practices ever get large enough where they say it doesn't make sense to continue paying 7% of collections?
I mean, never say never, knock on wood here, but we're 15 years into this now, 14 years into this now.
Mm.
If I were to tell you our logo churn for last year, I would say, oh man, what is it? Like probably 90% of it was like startup practices kind of fizzling out.
Mhm,
And then maybe the remaining 10% was private equity roll-ups or something of that sort where they got absorbed into a larger chain that has like a master contract somewhere. So could it happen? Absolutely. But, the thing to think about is that on a total cost of ownership basis, the math always works in our favor. And I don't say that in any like
mhm,
aggressive, way, but the math is the math. Like let's like for our biggest customers, it's easy. It's one thing to say, "Gosh, I could save more money," but it's like, well, let's go price it out. You
mhm,
know, let let's go first. Look at the contract value, and I encourage it. By the way, I'm like, hey, go, let's go do it. I'll help you. But it's like once you add in the per user pricing, all that stuff, and then you bake in the third party billing or the in house billing you're going to do, and then you account for the inevitable leak of missed revenue. The math, it just doesn't work.
mhm.
There's no, I mean, again, knock on wood, never say never, but we haven't lost an enterprise account on that in ever. So here we go. I just said that, and
Yeah.
by the time this publishes, I'm gonna have a headache, of course. But
Yeah,
hey,
knock on wood. So, well,
you know,
appreciate that insight. And let's talk a few stats and figures right now. What year did you found your company? So 15, 16 years in. So it was around maybe 2000.
yeah, yeah. I know. Well, just to be clear, I didn't found it. My
Okay.
somebody I went to high school,
Oh,
Kim
okay.
Peacock, founded it. She's still with us here at the company. So it was, I want to say it was March of 2010.
2010.
Is when it was
Okay.
founded. Somewhere I can
Okay.
give you the exact date if you
Yeah.
want, but it was somewhere
Oh,
in March
sure.
of 2010.
So found around 2010, so a long run here compared to a lot of companies right now. And then you mentioned kind of fully remote virtual presence.
Well, let's talk about that actually,
Oh yeah.
because
Yeah.
and let's talk about that because it's easy to look at our history and be like, "Oh man, how in the world you get," but here's the thing. And I say this with all the respect in the world because Kim worked her butt off to make this thing go. So, I would say just for the sake of time and brevity, I would say you can kind of categorize our company's history into like what I would call 3 distinct eras.
Hmm.
The first era was probably the first 10 years. 2010 to 2020 roughly is our first era. We were really not differentiated too much from a normal RCM company. Again, I say that with all the respect in the world. Her brute force and all that got us, there. But then inevitably that got us to what I would call our second era. And let's just loosely call that, I don't know, 2020 to 20 late early 22 maybe.
Hmm.
I'm probably off by maybe a couple quarters here, but
Hmm.
the second era was like, hey, let's connect via API to existing EMRs and see if we can pull the data out and become more efficient. It didn't work. Well, technically it worked, but our business didn't get any better. Our customers still blamed us for mistakes. Like they'd be like, we'd be like, hey, yeah, you didn't get that claim paid because that client or that patient was only authorized for 6 visits. You let him in for the seventh. And, when you explain it that way, you're like, "Oh, yeah, I guess that makes sense," right? But it's an icky feeling, right? Because you shouldn't have had to have that feeling. And that led us to our 3rd and current era where we just killed off all API connections. We're like, if we can't stop something bad or reimbursable from happening at the point of service, we can't be part of this. And so the 3rd era is the one we're in now where we killed off all connections to other EMRs, and we had to build our own. And that's kinda like where we've been for the last 2, almost 3 years, maybe somewhere in there. And so, like, there was this kinda transition from being an RCM company to kinda being somewhere in between, like a tech-enabled RCM company. to now truly being like a tech company. And we just think about it as, how do you build the operating system for profitable practices? Well, every piece of software that practice touches needs to have some tie back to the billing awareness piece. Well, anyway, let me pause
Yep.
there because
No, I
that's the
appreciate,
story.
yeah, because a company in business that long, there's going to be some pivots and journeys. So you said, yeah, kind of first 10 years, typical revenue cycle management company, then doing the API thing didn't quite work out or didn't help, but then building your own EMR and now more of a full suite of products. So
Yeah.
appreciate that insight.
The most difficult part of that, which is not part of today's episode, I think, but just as a placeholder, if the audience ever wants to
Mhm.
talk about it later, is that in each of those eras, you have to gently, but firmly. I don't know if you can do gentle and firm, but anyway, you have to also navigate company culture. And so there's something there that could be a longer conversation. So we've essentially had to reinvent ourselves 3 times, but our
Yeah.
average employee tenure is way past 5 years. I mean, I can pull the numbers, but it's like
Mm.
our average employee's been here at least 5 years, if not more. Um, so
Yeah.
hopefully that means we've navigated it well.
And talking about your team, what's your current team size?
So we're recording this in October of 2024. We are at, I believe, 47, and we are equally, and we're largely distributed across 14 states here in the U.S. So no
Okay.
overseas people at this time or anything like that.
Okay. And then anything you want to share around revenue ranges, you size a company?
Well, we're privately held, I guess, so we don't really talk about it, but
Mhm.
we do expose all of our data, so you can do the math. I told you we do 7%, and we keep 7. If anybody really wants to get crazy, you can kind of go on the website and do some math and figure it
Mhm.
out.
Uh, all right,
So
we'll be doing that math. Figure out revenue range. Perfect, perfect. And then tell us a little. Let's talk a little sales, go to market here. So, what does that process look like? What kind of go to market motion are you employing to find these people who are probably very busy? I'm guessing owners slash practitioners in their practice, or maybe sometimes you have a practice, office manager, or maybe it's part of a huge, practice. But tell us a little bit how you're finding these folks.
I'm smiling because this is I think the fun part. So let me preface this by saying that from 2010 to probably late 2022, we probably spent a grand total of 1% of all revenues ever on marketing. Like nobody in marketing, no spend, nothing really. It was effectively 1%. Anyway, now to answer your question, we are at this time 100% inbound, 100% word of mouth and inbound marketing, because you're right. Well, I should say what you alluded
Mhm.
to is correct, which is we're not the kind of thing that you wake up on a Tuesday and you say, "Oh my gosh, I can't wait to switch my infrastructure to something else," right? Nobody thinks like that. So if you were to think about our like napkin, like let me just kind of give you our napkin version of what our strategy is for go to market today. It is essentially pay per click SEO. So pay per click, search engine optimization, content, and PR or press
Mhm.
releases or PR. So
Mhm.
those are the four that we've done up until now. And then as we kind of roll into next year, you can probably add in conference strategy and other stuff like that. But as of today, everything's 100% inbound, and our entire, you know, all of our tactics have really been built around this idea of just you give away our data, anonymize it, aggregate it, give it away in terms of free calculators, free benchmarks, even free content, and we just flood the zone with content. And if I sound weird about it, it's because like to me, it seems really simple what we do, but it's also like I'm always surprised that not no more companies in our space don't do this.
Let's do
So
it.
yeah, I can
So
unpack anywhere you want
yeah,
me here
so
if that's
100% inbound. So pay per click, SEO, content, PR, conferences coming up, and then once you get that inbound lead, and maybe they download something calculator, and it seems like a qualified lead. Are you passing it over to someone?
Yeah, okay, so this is a good question. Okay, so stop me if I'm getting too tactical for you,
Mhm.
but the way we think about it is that okay, so top of funnel is just distribution. Make something interesting, whether it's a calculator, benchmark reports, real-time benchmarks, content, whatever. Flood the zone at the top of the funnel, get as wide as you can with that. And even with pay per click, some of that budget is obviously spent on long tail search terms, but a lot of it is spent on retargeting. If you interact with any of our content, let's retarget and just that means you're interested. Let's just kind of go through that. As you come down that funnel, that's what we call third party relationships. We're essentially putting content on third parties to get you to come build a relationship with us. What we then want to do is try to get you to make a first party relationship with us. Well, what does that mean? Well, we do feel very strongly like I hate those PDF downloads. Like I legit hate those things. It's like I know what you're doing and this is annoying. So the way we think about it is we try to give away what I call 99% free. Just give 99% of the information free. If you go to our benchmarks right now, for example, and you pick a state, you're going to see everything free. But there'll be maybe at least one chart on there that is gated by an email address that says, "Hey, just put in your email if you want to get this." And it's the chart maybe, for example, and off the top of my head, it's probably the chart with historical data. So if you're like my mom kicking the tires and you're like, "Huh, wonder what this is." You can do it. You can see it. There's no incentive for you to you don't care what the historical data was. You're not going to put in your email, right? So there's certain actions we then try to get you to do to help us figure out, are you Paul's mom kicking the tires? Or are you what we call a marketing qualified lead, meaning you did something that tells us that you are that practice owner or that clinician. And now from there, you enter our funnels and we then kind of drip content to you. And then from there, if you decide that you want to talk to somebody, we call it speak to an expert. We try not to use book a demo or anything. When you click that, you'll get to a scheduling page. You can see real-time schedules and you can pick a time to talk. And then, yeah, we have 2 or 3 people on our team that then field that. These are actually, in our case, we've got OTs, PTs, stuff like that, that are actually on that team that, yeah, I mean, classically, they're on our sales team, but really, that first call is what we call a discovery call. Let's just try to figure out whether to point you in the right direction or show you a demo in the next call and then kind of go from there. But that's the summary. Again, happy to unpack it further, but also understand if I already kind of covered too much that you,
No,
you know.
that helped. I love going top funnel to bottom of funnel, and then, that trigger that maybe shows qualified intent. And then, like you said, then speak to an expert. And it's interesting. So you're bringing in subject matter experts, people who were in the field. It sounds like OTs, PTs who can then talk the talk when they get on a call with a prospect.
Yeah, I mean, and that's a relatively new thing, by the way. So
Mhm.
prior to, let's see, prior to actually, it's been a year now. Prior to a year ago, we didn't actually have any clinicians on the team. We were really just focused on customers and, hey, how do we make this better? And we did that, right? We listened and all that. But over the years, we really started to realize PTs trust other PTs that have seen those clinical workflows. OTs trust other OTs that have been through the struggle of documentation and getting reimbursed and all that. And so for us, and I admit I probably should have figured this out sooner, but it wasn't until probably the third or maybe the fourth quarter of last year when we kind of realized we should probably bring in people that have been in these painful positions before. So I don't want to I only share that because I don't want to make it sound like we were super smart and we figured out how to bring OTs and PTs in 5 years ago.
Yeah. Well, let's close this deal. So you talk to the clinician, and what if then the prospect says, "Hey, sounds good. Is this self-service sign up, or do you send them a contract? Like, how do you close that deal?"
Yeah. Okay. So no, it is not self-service because, and to be clear, I mean, yeah, could we make it self-service? Yeah. There's no technical limitation there. But given the way that our revenue works, I kind of shared how that works earlier. Because of the way that revenue works, we really need to understand how that works, and where your contracts are, whether your NPIs are registered correctly, all that. So, all right. So generally, the way it works is we are kind of low pressure. We try to kind of keep the business side separate from the you know the people side, if you will. So the way I like to think about it is on the spreadsheets, I try to model out, predictable revenue. It helps me figure out how to make sure we don't hire ahead of our profits and things like that. But the way it works is that we will kind of shepherd you through the process, do the demos for as long as you need, tailor it to whatever your needs might be. And when you're ready and you say, "Yeah, I'm ready to go," then we'll issue you an electronic contract that says, you verify everything you said is real and you know what the pricing is and all that. But you also agree to then give us access to all these materials that we need. So all your payer contracts. And from there, once you sign that, you're actually gonna get access to an onboarding dashboard that we built over the years where it's pretty straightforward. Like it's visual and it says, okay, we need to copy this, this, and this. And as you upload it, this little chart kind of moves. So it kind of gamifies it, makes you feel like you're winning and all that. But we get all your info. There's a dedicated onboarding manager. And then, technically you could be live within 2 or 3 days if you really wanted to. But in practice, most customers are, anywhere from 2 to 3 weeks once they've signed the contract. They need to, like,
Mhm,
provide all the data. And then we do the full migration of your data over during that process. So it's a hard cut. You pick a date
mhm.
and we do a hard cut. Your data's carried over. You basically close out in your old system on one weeknight and you just wake up the next morning and log into the new one.
And two clarifying points, does the clinician take that to a closed deal, or then are you handing that off to an actual sales rep to then issue the contract, get the signatures?
You're talking about in our team?
Yeah, on your team.
The clinician is the sales rep.
Okay, just make sure. So they're handling that to close.
Yeah,
Yeah,
yeah.
yeah,
I
and
I
yeah.
do wanna touch on one thing though here in case it's helpful, because I know with your CFO background, this may or may not be an angle you wanna go. Because of the way our revenue works, if you were to simplify our business grows, it has 2 levers to growth. The first lever is new logo acquisition. It's what we just talked about, right? The other level, whether or not we want to talk about it, is unit volume increase. So when we think about whether you're on our platform, you're new on our platform, or you've been on our platform for 90 days or 2 years or 5 years or whatever, we've got one side of the sales team that's just thinking about new logos, and then the other side that's actually looking at existing accounts and saying, God, for example, hey, gosh, 36% of your patients last week were RTM eligible through some combination of Medicare and private payers. Did you know that we've got this baked in RTM system that it'll just show you, the button will appear, So it's things like that where we're actually
Mhm.
trying to educate the customer that there are additional opportunities available there for not only for them to make money, but also to provide a better patient outcome as well. But those two key levers are, you know, like you mentioned this a little earlier that I thought was interesting because it's right. Is that to a lot of SaaS people, our model doesn't make sense because you have this inherent volatility of, metered pricing and things
Mhm,
like that, which is true. But, with healthcare, unless there's like some catastrophic issue in a large part of the country, some
mhm,
patient is being seen somewhere in the country. So we're good there. But the other side of it is a lot of practice owners and clinicians don't realize that there may be additional treatments available or additional opportunities for unit volume. It's like it's almost like taboo to talk about, right? Because we're all looking at better patient outcomes. But there are opportunities there. So that's the other side of that
yeah.
metered-based pricing is that it sort of incentivizes us to kind of also find growth opportunities for them as well.
Yeah. Yeah, that help you and help the clinicians. So yeah, I love that. So let's switch over to the fundraising side. How much capital have you raised to date?
None up until this past month. So
Mhm.
we were entirely bootstrapped and we were reliant on our own profits and customer base. And then I don't know when this will go live, but in Q3, I don't
Mhm.
know how you want to do this based on when it gets released, but in Q3 of this year, we raised 25 million in outside capital.
Okay, so 25 million raised to date, just happening, bootstrap the whole time. And then tell me, I, so yeah, bootstrap for say 16 years roughly. And then what triggered this? What happened in the business decisioning that said, "Hey, let's raise some outside capital"?
Yeah, well, okay, so there's the complete answer, which we probably don't have, enough time here on your show. You'll lose a lot of listeners here. I think the blunt answer is that, we had grown this thing and we saw like the outcomes for our customers. Like I can't articulate this to you without examples. Like we've had customers that came to us like, in the middle of the night saying like, "Oh my god, I'm gonna miss payroll," and we're like, "Okay, well, we can't make a miracle happen, but we can get you on board and we can at least capture some of that revenue for you and fix it." And we've had those clients for years now, and now I'll get text messages like just the other day, I was supposed to meet with one of my clients and just a catch-up call, and he canceled, like, he didn't show up, and I was like so I emailed, I was like, "Hey, are we gonna meet?" And he texted me back, he's like, "Hey, I decided to go to the Keys, the Florida Keys last minute." And I was like, "Oh, okay, cool." And in my mind, I was being kind of a smart ass. I was like, "Well, you could have let me know, right?" But he was like, "Hey, thank your team for letting me do this."
Mhm.
And, he's half joking, half serious. Like these are customers that, when you're the difference between like collecting 80% of what you're owed and 99.999% or whatever is the difference between a 3% profit margin where you're barely making ends meet and a 23 or 24% profit margin. So we kind of like came to this conclusion of like, man, we have grown this thing. We'd like almost doubled the revenue in a year. Like we only started our marketing efforts like a year and a half ago. And it was like, man, like what would it look like to go faster? And I'm also at a point in my life, and I'll just speak for myself and not the team. For me personally, I'm also at a point in my life where I'm 43. I don't feel old, but I also kind of become more aware of how much time I have and what a limited resource it is. And it's like, well, what could we achieve if we put more gunpowder in this thing, you know? So we can unpack that if you want. I want to be respectful to the
Mhm.
audience, but it was an existential conversation internally because being privately held. Here's what I'll say: it probably took us, I would say, 4 months of soul searching, like hard conversations,
Mhm.
difficult conversations, tears from some of the people on the team, before we even like finally committed to doing the fundraise, and then probably another 3 months to hit the fundraising circuit, go through diligence, and get to the finish line. So all in all, maybe 7 months, but four of it was probably internal, and probably we probably should have just hired a company therapist and have them shepherd us through the process.
A, a company due diligence fundraising therapist. Yeah, yeah, I can see a
Well,
need for that.
well, but to be fair, the angst was less about the diligence or the pain of that. It was really more about like the uncertainty of what would change, because when you only answer to your customers and yourselves, you don't like we didn't have growth targets before. Like we
Hmm.
didn't have, and okay, I'm probably going to overshare here a little bit, and you can edit this out if it's not useful. Here's the thing people don't talk about when you're actually building a business. They don't talk about like the stress. Like there's this like dream of, gosh, if I bootstrapped it, I wouldn't answer to anybody. Oh my gosh. And there's this like undertone of like freedom when in fact, like when there's no other safety net other than your profits and your customers, you're thinking in the middle of the night, like, "Oh, man, did I fill out that payroll form correctly? Is there like a threat around the corner that I don't know about?" And you do this for long enough and you're like, "Well, that sucks. Like we can keep doing it, but man, like why what would it look like to kind of go faster? Maybe have some adults with us that have kind of been there, done that." And so really it was kind of like, what needs to be true for us to be happy? Well, what needs to be true is that we want to stay focused on the mission, but we're willing to kind of maybe compromise and learn a little bit more about like, how do you build forecasts? Like we never built a forecast. We just kind of said like, let's just try to make more money next
Yeah,
month.
that's important. Got a forecast at some point. Yep.
Yeah. I mean, you get that as a
Yeah,
CFO,
I see.
right?
Well, yeah, yeah.
Yeah, but like we never had that. We never, I mean, if you looked at our org chart, we still don't have a CFO.
Mm.
Now we're only like 30 days post close, right? So
Yeah.
that's going to change.
Hmm.
But as we think about our 2025 roadmap, it's like, I don't want this business to be reliant on, again, I'm oversharing here. Up until this point, we had key man insurance. For me and my business partners, we had key man insurance, like just in case a bus hit us. And like we thought that was the right way to go. And probably at our stage in the early days, it was the right way to go. But now we're like bigger. We've got like 47 people relying on us for paychecks, presumably more every month from here on out. And it's like, what is right for the business? Let's get some adults in the room that have been there, done that, and see where we can go. So again, happy to like put more color on it. But yeah, fundraising is difficult at any time. But the bright side is for us, we actually did it, I think, in the most challenging environment in the last 10 years, and we did it successfully. So
Yeah,
there's
yeah,
something good to be said
yeah,
there.
yeah. No, and appreciate that because we could talk for hours on each of these questions. But one last question before we talk metrics and wrap it up. For other founders out there, and we know there are a lot of bootstrap founders out there who are on their journey. It's not just 2 years in, but 5, 10, 15, 20 years in who are bootstrapping. Any any considerations or lessons that you'd like to pass on in your that 4 months of soul searching of like considerations or just things that maybe help clarify their thinking if they're wanting to raise some outside capital?
Okay, so I'm going to preface this by saying that, again, we are today a team of 47 different opinions, humans, all that stuff. So I'm going to preface this by saying that what I'm going to share with you is what I believe personally in my personal capacity. And that's not a dodging cop out. it's a recognition of the fact that like, well, anyway. So the way I think about it is like first and foremost, you need to think about money as a tool. I think often people think about money in the context of venture capital, private equity, friends and family financing, loans. They think of it as like some gatekeeping tool where it's like, gosh, if I just got that, then I could do that. But if I could, if so, the first thing I would share is we need to like get rid of that mental construct and first zoom out and ask ourselves, what does success really look like? What are we optimizing here for? Some people would tell you, I'll tell you my answer here in a minute. So, and when you really push that on people and you say, what are we really optimizing for? Some people will say freedom. I want the ability to focus on my kids whenever I want. Some people will say, I want power. They may not say it right away, but if you like poke them hard enough, maybe put 2 glasses of wine in them, then maybe they say, well, I want to go to my 25th high school reunion and be the big guy. Others will say, I just want a lot of money. And whether it's because I want to pay for my kid's school or a big ass house, whatever. But if we can start from the premise of what does success look like, then we can kind of get to the next stage. And for me, through the arc of my career, not just here at Strata, through the arc of my career, my answer has always been that I optimize for fun and profit. And I don't mean that in like some nefarious way. What I mean is that like building businesses is inherently hard. So if you're going to do it, let's at least do something that you find fun. I
Right.
find growing things to be very fun, and then profitable. What I mean by that is like in this context, I don't mean like, gosh, I can't wait to take distributions. The way I think about it is like, you know, what is an industry that like is so massive that if I'm going to spend 5, 10 years on it in a very finite life that I have, what would be big enough to maybe make an impact, you
Mm.
know? And for me personally, I just remember my parents were immigrants, and I remember like as immigrants, they would say like, "Oh, well, doctors and lawyers are rich." And I remember that didn't make sense to me because when I would drive around here in Virginia growing up, when you would drive by a doctor's office or a lawyer's office, you didn't see Lambos and Ferraris everywhere. You saw like Camrys and Accords. Now, I know that's not true everywhere, right? But like it didn't make sense to me. So anyway, my advice, let me come back to the advice. Number 1, let's be honest with what you really define as success. Number 2, then let's go back to money and remind ourselves that money's a tool. But on this topic, let's be really honest with ourselves. Is money truly the reason that you're held back? In our case, I can tell you right now, like, you know, could we so we were already bootstrapped and profitable. We had multiple angles of money to go after if we wanted to. We could have, I'm making this up, but we could do SBA loans. We could have gone down venture capital. We could have gone, I mean, there's a lot of different ways. There's a
Mhm.
lot of sources of money. You could go family offices. You can go a lot of different ways. But in our case, it was like, well, we're optimizing for growth here. That's really like, despite all the different opinions and everything, once everybody agrees and is honest about what they want, everything kind of aligned back to like, yeah, it would be fun to go faster. And it would be fun to kind of grow a little bit too. A lot of our employees have never been on a, rocket ship. Like growth is sort of uncomfortable. It's like,
Mhm.
okay, well, what does this industry need? This particular industry, in my opinion, is unique in the sense that money alone doesn't solve the problem. Like if I went to Silicon Valley and I got a bunch of people on Sand Hill Road to invest, we'd have money, but we'd still be lacking like healthcare experience. And so in this case, it was like, what does it look like to actually identify a investment partner that respects profits? Like, because we don't want to become like, like the typical venture capital model that I admit I'm involved in. The typical venture capital model is screw the profits, let's go upside down and get the growth. That's good for early stage, but I don't. That's not where I'm at in my life, and not where our company's at. So in this case, it's like what is the subset of investors out there that, respect profits, love growth, understand our culture that we can get along with and all that. So I'm rambling here a little bit, but it really does come back to let's be honest with ourselves about what we want individually and as a team. And then number 2, let's also acknowledge the fact that there's lots of different sources of capital. And if we're truthful about the first thing, then we can actually whittle down the subset of remaining sources of capital because not all those sources of capital are good depending on what your answer to question number 1 was, you know?
Right. Yeah, no,
Um,
yeah, not all sorts of capital are created equal, just like not all ARR is created equal. But yeah,
right,
yeah,
right.
appreciate that.
Yeah,
Yeah.
yeah, and this is we could do a whole I mean, I mean, look, you're the CFO, right? there's a bad joke coming here. It's like you're like Toby from The Office, and I'm Michael Scott, right? Because I'm like trying to stay as far away from you as possible.
Mhm. Right.
But we need you, right? And so the thing is like, you know, we could do a whole different topic that you already know about, but I bet you the audience doesn't, is like, hey, let's say you did go down the venture capital or the capital route. Do you really understand where the capital came from? Because a lot of what investors tell you will be not, it'll be framed as their advice, but actually it's driven by the limited partners that they're managing money for, and that we could
Mhm.
do a whole different episode, as
Yep.
you can imagine, on that. So,
Yeah, maybe we can do
um,
one on the investor side to help the founders think about that. So really appreciate the sharing your journey and the experience, Paul. And one last question before we wrap up. At this stage of the company for Strata, do you have a favorite number or metric or metrics that you're focused on to guide the business?
you mean in terms of like daily or monthly metrics?
It could be daily, monthly, it could be product usage, financial metrics.
Okay, so on a monthly basis, okay, so I'm trying to just organize my thoughts here because there's a dashboard that we built that I like refresh every hour. And then there's the dashboard that we collectively fill out to keep ourselves accountable to each other every month. So let's start from the latter. So in terms of, the financial reporting and all that, very standard sort of P&L that you're probably used to, and so if I were to just kind of help you imagine it, I feel really strongly that we track patients, visits, and units as our North Star metrics because that tells the story of whether or not we're really growing. Then the next block of metrics that we look at on a monthly basis is what we call growth metrics. So that's like, okay, how many views across our distribution platforms did we get? How many emails? How many MQLs? How many SQLs? Conversion rates, right? So those are the growth metrics, and you can even like as you get further down that funnel, we can actually put an expected ARR, MRR, even though it's not, as a metered business, we don't really have MRR, but you can model it, right? And then the third box is essentially like efficiency. So we're tracking how much our headcount is in each functional area, like, G&A, useless people like me versus, different teams. Interestingly, by the way, right underneath there, we're tracking churn. So I don't want to churn people. Like, obviously there's involuntary churn, like, hey, you didn't hit the metrics or you were just not growing with the business. But I do wanna keep an eye on voluntary churn. Like, did somebody leave because we put a wrong supervisor in place? I don't know. And then you get into the final section around efficiency. What is the average revenue per employee, average revenue by team, sales efficiency, things like that. So that's like the monthly thing that feeds into
Mhm.
like, our P&L and, all that
Mhm.
normal. We're not GAAP, but we're trying to be really close to that.
Well,
And then on a daily basis, we have a lot of operational metrics. So I have this like dashboard that we've built that I kind of keep in a tab that refreshes every hour. And it's every operational thing. I mean, it makes your eyes bleed. It's probably too much detail for anybody, but we've all been doing this long enough where I can be like, "Oh, okay, it's like 4 o'clock Eastern. That number's a little lower. What happened? Oh, there's a hurricane in Florida, and I know I have 12 people in the path. Okay, that's okay." You
mhm.
know? Well, not the hurricane's okay, but I'm saying like, okay, I don't have a problem. I don't have a leaky bucket here. So,
Yeah, yeah.
um, yeah, that's the gist there, but happy to put more
Okay.
color on it.
No, no, that's helpful. Just always interesting to see what you're tracking at this stage. So, Paul, really appreciate the time today sharing your journey, experiences. If listeners would like to learn more about Strata, where should we send them online?
Okay, so easiest way to find me is paul at stratapt.com. And bonus points if you put the SaaS CFO podcast in the subject line so I remember where you came in from. And I'll also apologize to the audience for what may be an episode that is 2x as long as a normal episode. But we'll see. Maybe
Yeah,
they'll reach out to you and they'll want more color on something we talked about. And we'll
yeah,
see.
definitely. I love that. I love that. Well, check out stratapt.com. And if you want to reach Paul, email Paul at stratapt.com.
Yeah.
And,
You can find me on social media, Paul Singh
yeah,
on
LinkedIn.
Twitter, Facebook, LinkedIn, whatever. Yeah.
And yeah, there's so much to dive into. Appreciate it. Yeah, a little longer than normal episode, but great journey so far. So that's worth sharing to the SaaS community. So Paul, again, really appreciate your time and sharing your journey today.
Hey, likewise, man. Thanks for making the show happen. I've been loving the episodes and I hope this helps at least one person out there.